So what is capital gains tax and why are people losing their minds over the government changes that are just... So firstly, to understand capital gains tax, we have to understand what a capital gain is. So let's say you had a $500,000 property and it goes up in value to $1.5 million over a period of time. That value increase from $500,000 to $1.5 million is called the capital gain. In this case, $1 million. Now, under the old scheme, basically you get a 50% discount on that, and so you only pay tax on $500,000, but that $500,000 is added to your income, and that means if you're in the top rate of tax, the most you're going to pay is 47% on that, which is $235,000, which $235,000 out of the million sounds like it's a 23.5% tax rate on the overall gain. So that was the old system that does not apply from 2029 onwards. So the changes are taking time to adjust. The new system actually changes the value of the property that you bought. So let's say you bought a property for $500,000 and then over time it goes up to $1.5 million. Under the new system, we adjust the cost base for inflation. So let's say you've had 3% inflation over a long time period, let's say 24 years, which means the value doubles, so that now that property has gone from, your cost base has gone from $500,000 to $1 million. The property, however, is worth 1.5, so your capital gain is the difference between the two, which is 500,000. So the minimum 30% tax only applies to the $500,000 gain, not the whole $1 million gain. And obviously 30% on 500,000 is 150,000, which is actually only 15% of the gain, of the actual numerical gain. It sounds like that might be cheaper than the old system, but it's still added to your income. So the $500,000 is still added to your income. If you are in the 47% income bracket, which $500,000 gain would push you into anyway, then you will still pay $235,000 in tax. If you've had to pay a minimum of 150, then you're over the minimum and you pay the 235. But if you did it in a tax year when maybe you'd retired and it was split between two people that weren't earning any other income, then they would be in a lower tax bracket, which theoretically means they might pay less than 30%, then the 30% would kick in. So it doesn't make much difference over the long run because the cost base is changing by inflation. And by the way, when capital gains tax was first introduced, this is exactly how it was set up. It was changed in 1987 to be the current 50% discount rule. So they've just changed it back to what it was in the 80s. That's pretty much it. No need to lose your mind. Now, the big losers from this are people that buy a property that jumps in value over a short period of time. So let's say you bought a property for $500, it jumps in value to $800,000 in maybe only 3 years. Well, inflation is only going to adjust the property value by around about $45,000, $50,000. So your cost base goes from $5 to $550, and now you're going to pay tax on $250,000 rather than the $150,000 you would have in the old rules. So the people impacted are going to be the ones that get a sharp windfall gain in the short term, which also includes property developers and people doing flips. They're going to get impacted way more than long-term investors, where inflation pretty much takes care of it for you. Does that make sense?